Without further ado, thank you all for joining and wanting to spend your night talking about taxes. I'm sure that everyone's got some better things they could be doing, but I appreciate the interest level in this new tax legislation. So my name is Brent Robbs. I am the Director of Tax Strategy and Services at Larson Tax Partners. And tonight we're going to talk about the Build America Back Better Act, or the Buildback Better Act. And then we're going to talk about how do you plan for something when you don't really know what it's going to look like in the end. Here's our agenda. We're going to start by doing an overview of the proposal, or proposals for that matter. Then we'll break down the major provisions that are included in the last version. We'll talk about some 2021 action items. We'll talk about 2021 specific tax planning ideas, and then general tax planning ideas as well, because those are still good this year. After that, we will we'll answer questions, and that brings me to my housekeeping items. So one, your microphones have been muted. You're welcome to chat any questions that you have as we go through the presentation tonight. My plan will be to answer those questions at the end. But we're also monitoring the chat, so if there's a recurring question that comes up, we might go ahead and answer that midway through the presentation. A copy of the slides can be downloaded from the handout section of your viewer on the right-hand side. And then lastly, when this presentation ends, you'll be sent a follow-up email, and you can use that link to view a recording of this webinar at any point in time. So I think that gets all the housekeeping items out of the way. I guess depending on your personality, either grab a coffee so you can stay awake, or maybe grab a cocktail so you can cope, and we're going to start talking about some of this tax law. All right, so it's been nothing short of a soap opera watching proposed legislation over the last couple months. The first version of the Build Back Better Act was released on September 13th. By the House Ways and Means Committee. That first version, that startled tax practitioners. It included way more than really anyone expected. So from increases to ordinary income taxes and capital gain taxes, to cutting the lifetime exemption for estate tax purposes, changes to business taxes, corporate taxes, international taxes, you name it, it was in there. And I know myself, I was concerned. Now, from a tax planning aspect, it was kind of exciting. I mean, I am at heart a tax nerd. And so being able to see all the ways that we could plan for 2021 before all these changes went into effect in 2022, that was great. But the big loser in that first round of proposed legislation was really the taxpayer. At least the individual taxpayer is what we're focusing on tonight. Now, since that first version, we've had a revision that was done on October 28th, or released on October 28th. And then we had two amendments, manager's amendments since then, where we've added additional text to those proposals, but there haven't been formal revisions at this point. I also want to make sure everyone is aware this is still proposed. This is not the first time I've given this presentation, but it also is the first time I've given this presentation. And what I mean by that is the first time I did this, it was covering that original proposal. And we're going to break down how it's changed over those different variations. But keep in mind, this is a 2,135 page proposal. The summary version is 180 pages. We're going to try to get through what I think are the highlights in about 45 minutes. I'm going to do my best to simplify, but ultimately this is complicated tax law. And really, while we're going to talk about some planning points, you need to speak with a tax professional about your specific situation, rather than just relying on some generic advice based off of not knowing your tax return. One other thing to mention, as of now, we are expecting a vote in the House on this bill next week. Just because we're expecting that vote in the House, that doesn't mean that this is going to be the final version. After this version is completed, the Senate will develop their own version of the proposed legislation, and they will vote on that as well. So some of the things that we've seen in prior proposals may end up being added back. Some things that are currently there may be taken out. Recently, actually today, I read that Senator Wyden out of Oregon is still pushing for adding a billionaire's tax on top of everything else that we're about to talk about. So there's a lot of moving parts still to come, but let's get into some of the highlights of how things have changed here recently. And I think this is, if you had to reference one slide from this presentation, I think this is the one that I would reference, because it's going to give you an idea of everything that has happened since September 13th. Let's start with a high level. The first version of the Buildback Better Act was for a spending of $3.5 trillion. That second revision was for $1.75 trillion. And then the third, with the amendments to the far right, that ended up being about $1.87 trillion in spending. With all that spending, we obviously have to figure out, how do you pay for it? And the way that budgets work in Congress is that it's over a 10-year period. So sometimes what logically seems like it would make money for the budget isn't necessarily what gets enacted, because we're looking at it over a 10-year window at all times. So for the original version, you can see it's really the longest list, and it actually has the most changes for what I'll call maybe the ordinary taxpayer. So the first thing that happened with that original proposal was the top tax rate went back to the Obama era rates, which is 39.6%. Currently, our top tax bracket is 37%. And in addition to not only raising that ordinary rate, it reduced the income threshold where that rate actually kicked in. So roughly for married couples, $600,000 is roughly where the top tax bracket, or 37%, kicks in today. The proposal was calling for that top tax bracket to kick in at $450,000, and it was going to be 2.6% higher. So a major change for a lot of taxpayers that are at least making that much money on an annual basis. Now, they also targeted capital gains tax rates. Currently, our capital gains tax rates are either 0, 15, or 20%, depending on your overall income. And they were going to increase that rate to 25%. So a 5% increase on long-term capital gains. Another big blow to ultimately wealthier taxpayers, because if you have an investment in a taxable account that you've held for over a year, or maybe even real estate or a business that you've held for over a year, when you sell it, that's when you incur those long-term capital gains. So we were looking at that 5% increase with this version of the bill. There was a 3% surcharge on modified adjusted gross income greater than $5 million. So this is another tax, layer of tax, but again, targeting the highest of earners in the country. The next point, that 3.8% net investment income tax, we're going to go through that, because if you look across the columns, that one is still in the final version of the bill that we have today. The restrictions on Roth conversions, again, we're going to go into that in more detail, because that's still in the final version, or in the current final version, I'll say. The accelerated required minimum distributions for large IRAs, again, we're going to go into that in detail. And one item that we're not going to go into, and this was one that many estate planners and tax planners were worried about, is the reduction of the lifetime exemption. So currently, you're allowed $11.7 million per taxpayer without paying any federal estate tax. That was slated to almost cut in half, down to $6 million. And again, that was in that first version, which is no longer. But just because it's currently not in the version that we're expecting the House to vote on, it doesn't mean that the Senate isn't going to look at some of these ideas and try to bring them back in on whatever version of the bill they vote on. So then let's fast forward to the revision. With the revision, we took all of those items we were so worried about and threw almost all of them out the window and came up with some new things. There's a 5% surcharge when modified adjusted gross income is over 10 million. So again, targeting the wealthiest or the highest earning taxpayers in the country. And then once income gets above 25 million, an additional 3% surcharge on top of that. And again, you'll see in that far right column, those items are also included there. So we're going to go into that in more detail on the upcoming slides. We also reintroduced this limit on excess business losses. And again, that is still included in the bill as we see it today. And that brings us to that far right column. So we've talked about most of these items. The one new item that you see in this far right column is an $80,000 state and local tax cap starting this year in 2021. So retroactive to January 1 of this year, we are going to have an increased amount of tax deductions available to us on Schedule A, or where you itemize your deductions. And we're, again, going to talk about that in more detail, so I'm not going to go into more right now. But as we go through this, just to give you an idea of the projection of how much these individual taxes were expected to raise in revenue for, see here, get my notes. So for the first version, for the original bill, we were expecting $950 billion in revenue from individual income tax increases. In the second version, or the revision, we were expecting $504 billion, and in the amended version, $530 billion. So a substantial amount of revenue is being raised based off of the individual taxpayers. One other thing that I think is important to note, according to taxfoundation.org, which is where all of these stats are coming from, and if that's something you're interested in learning more about, I suggest go out and check out the website. But it's going to break down all of the spending, the revenue, and it breaks it down more so than what I've just done for you. But one of the items in there is the increased enforcement, or the additional IRS enforcement, and the expected revenue by boosting up the IRS. In the first version, it was $200 billion in additional revenue. In the last two versions, it's $120 billion in additional revenue. So I think the takeaway there is if you're filing your own return, if you don't have confidence in your tax preparer, now might be a good time to consider making a switch, because I think we're going to hear more from the IRS than we have in recent years. Assuming they can find the employees to staff up, they're planning to really start enforcing and probably doing more audits as a result of that. So that's what's happened since September. Major changes, kind of almost feels like we're in a game of Pong, where we bounce from one side all the way to the other side and then kind of back to the middle. Let's break down all of the items that we're expecting in the final version, or the version that's going to be voted on next week. I've organized this by section to some capacity, and then I kind of jumped around, but more or less, this is coming from the summary document that has been posted by Congress. And the first section we want to talk about is this additional net investment income tax. So net investment income tax is not a new concept. It's been around really since 2012 with the Affordable Care Act, also referred to as Obamacare, right? This is the bill that was passed to, it allowed us to have a tax to pay for the insurance mandate that was created at that time. And so the 3.8% net investment income tax is a tax that we have been paying on interest, dividends, capital gains, passive investments, like flow through K1s and such, rental, royalties, things of that nature. That is what we historically have paid this tax on. Now, the change is that in addition to all of those items, that 3.8% tax will now apply to active trader business income, but only when your income exceeds a certain threshold. So what does that mean? That means that if you're an S corporation, if you're a business owner and you have an S corporation, or a partner in a partnership, and normally you have this active income, not through a wage, because wages are explicitly carved out of this, but through a distribution or through just a flow through on the K1, that will now be subject to not only ordinary income taxes, potentially payroll taxes, but also this 3.8% tax on top of that. Really what they're trying to do with this rule change is level the playing field, because anyone that's a W-2 earner, anyone that has, maybe isn't a W-2 earner, but has very high investment income, they're subjected to this tax on one or both sources of income. However, the business owners are escaping without the 3.8% tax. Now, I mentioned wages, and it's not the net investment income tax that is on wages. It's actually considered the additional Medicare tax. So with Medicare, anytime you've got payroll, you're paying 1.45% for Medicare as the employee, 1.45% comes from the employer for a total of 2.9%, and then the additional Medicare tax is another 0.9%. Also comes out through payroll, so you may not even know when it's hitting you. But that tax, again, is getting us to the 3.8% number. So the same on the wages side and the ordinary income side as it is on the investment income side. Now, this net investment income tax does not kick in until your adjusted gross income hits a certain threshold. That threshold is $250,000 for married couples, $200,000 for single individuals. All of that is the kind of the first step. Now we're adding on this second step, which also looks at our taxable income as business owners. And if we can keep our taxable income under $500,000 for a married couple, $400,000 for a single person, then we're able to avoid the 3.8% tax. If we go over that taxable income barrier, now we're subjecting all of the income to that 3.8%. This is going to be a bear to plan for. I think that tax practitioners are going to have problems with it. I think it's probably going to be missed by a number of people, and we're going to figure it out in 2022, the first time that we're subjecting ourselves to this new tax. The plan, the planning that goes along with this is, one, let's run projections. So if you have a tax, I guess this is a good as point as any to talk about this. There's really two types of tax preparer. There's a tax preparer who really just puts the numbers on the forms and submits it to the IRS. And then there's tax planners. And I consider myself a tax planner. And I think that that's where you really need to, that's the kind of tax professional you really need to have if you're potentially subject to this type of rule change. So what do we do to plan for this change? One, we accelerate income into 2021. You see the effective date is January of 2022. So if you know, or we think that you're going to be subject to this tax next year, let's accelerate whatever income we have or can into 2021, because in this year, you're going to have ordinary income, but you're going to have that in either year. You're not going to have the 3.8%. The other thing that you can do is look at deferring expenses along with that. So instead of paying for a piece of equipment or a big expenditure towards the end of the year, push it off to 2022 when it's going to reduce down your income at that point, which is going to save you, again, that 3.8%. The second point on this page is a limit on your excess business losses as a non-corporate or individual taxpayer. The easiest way to talk about this is with an example. So previously, if you were a business owner and your business lost, let's just use round numbers, your business loses $1 million in a year. In that same year, though, you have enough investment income, interest, dividends, capital gains, that's also equal to $1 million. Before this excess business loss rule, you would pay no taxes in the current year. Now there's a limit, and that limit is roughly $260,000 per taxpayer, or $520,000 for a married couple. And any amount of that excess business loss that you can't use in a given year will carry forward almost like a net operating loss. So the planning points here, again, accelerate the business income, defer business expenses, and potentially opt out of accelerated depreciation. So what we're trying to do is make sure that if you have a loss, we don't want to make that loss any bigger than the limits allow us to deduct. And again, the effective date on this, actually in this case, the effective date is 2021. So this will apply retroactively, much like the SALT changes that we're going to talk about here in a few slides. Next, we want to talk about the surcharges. So there's a couple of surcharges for high earning individuals. There's that 5% when modified adjusted gross income is greater than 10 million. That 10 million is the same for a single taxpayer as it is for a married couple. So this is probably the biggest marriage penalty we've ever seen, because two single individuals would each be able to make that $9.9 million and not be subject to this 5% tax. But as a married couple, 10 million would be subject to this additional tax. So huge marriage penalty implications with this. For married couples filing separately, it does divide in two, so you see the $5 million number there. And then for estates and trust, it's only $200,000. So I'm going to talk a little bit more about that in a minute. However, if your adjusted gross income is over 25 million, there's another 3% on top of that. If, just to give, for fun, I guess, the top rate for someone living in California with 10 million or more in income in a given year would be 59.1%. And for 25 million or more would be 62.1%. So a substantial amount of tax, and not going to hit very many taxpayers. So what do we do to plan for this? This goes into effect January 1 of 2022. To plan for it, my suggestion is that, well, most of the time when your income is going to bump over these thresholds, it's probably because of a specific event. It's probably not that your income is that much every single year, but maybe you sell a business, you sell a large piece of real estate with a big capital gain, that might be what pushes you up over these thresholds. So one thing that I think we're going to see more of for large sales of businesses will be installment sales. You'll want to split it up over a period of years so that we can keep you, directly below maybe the 10 or the $25 million number that you see on the screen. Now for estates and trusts, these thresholds are substantially less, 200,000 for the first threshold and then 500,000 for the next. I think estate planners are going to need to get involved here, because what many estate planners have recommended for clients that have large retirement accounts is that not only, rather than naming an individual as your beneficiary, let's name the revocable trust, and then the trust is going to govern how distributions flow out to the individuals. The problem with that now is that we also have a rule that says retirement funds upon death have to be distributed within a 10-year window. Well, if you've got a 10-year window and you've got $1 million with no growth, you're going to have adjusted gross income in that trust of $200,000 a year if you just broke it up evenly. The other option would be to wait till the end of the 10 years or do it in lumps throughout. But nonetheless, there's a real possibility of hitting those estate and trust thresholds for a lot more people than the individual thresholds. The Next point on that page is the SALT, the state and local tax deduction. And we used to be able to deduct as much state and local tax as we incurred. And then the Tax Cuts and Jobs Act, as a way to get the bill to pass, when they lowered the top tax rate, and they lowered really all of the rates for ordinary income tax purposes, one of the things they had to add in was a cap on the amount of state and local taxes that we're eligible to receive. And so that cap was $10,000, $10,000 for a single taxpayer, also $10,000 for a married couple. The increase that is being proposed is $80,000 to $80,000. Substantial increase, going to allow many people to deduct all of their state and local taxes. And it's in effect temporarily from January 1 of this year through 2030, so for a 10-year time frame. Now, state and local taxes include your income taxes that you pay, but they also include the real estate taxes and personal property taxes. And if you're in a state that doesn't have an income tax, it includes your general sales tax. So there's a number of items that make up these taxes that are deductible, and it all goes on Schedule A, or your itemized deductions. So for the last few years, many taxpayers haven't been itemizing because of, specifically, probably because of this one rule. So I think we're going to see a lot more taxpayers moving from the standard deduction up to the itemized deduction, because you get the greater of the two. Being able to deduct up to $80,000 in this one section is going to really push people to itemize moving forward. What do we do for planning? For planning, there's really two scenarios. If your total state and local taxes are more than $80,000 already this year, then you're going to want to defer and not pay any more in the current year because you won't get the benefit. If the state and local taxes are under $80,000, we're going to want to accelerate. So if we know you're going to owe a payment to your state in April, rather than waiting to April to make that payment, we would make an estimated tax payment before the end of the year, which allows you to take the federal tax benefit right away, as opposed to having to wait a full year to get that benefit. The other thing to keep in mind with the state and local tax, we have a alternative minimum tax as well. Now, it's very hard to fall into the AMT at this point because there were a number of changes to it, restricting the items that are affected by it, increasing the thresholds where they apply. But I think there's a real possibility that in the Senate, there might be adjustments to the alternative minimum tax to bring that back into play, with the idea of if your income is over a certain threshold, if you're a certain type of taxpayer, even though your state and local taxes are not capped for regular tax purposes until $80,000, it might be restricted for AMT. That is pure speculation on my part, but I know that Bernie Sanders has definitely talked about that here in the last couple weeks. Now we're getting into the retirement plan changes. So there's a couple of retirement plan changes that are going to really impact, really impact a lot of taxpayers. And then there's this first one, which is impacting those who have the largest retirement accounts. And this rule change is that anyone that has an IRA with more than a $10 million balance, and now it's IRA, traditional IRA, Roth IRA, or even defined contribution accounts. So any of those accounts, if your total balance is in excess of 10 million, there's going to be new required minimum distributions that are implemented beginning in 2029. So we've got some time to plan for this, but in 2029, if you have a balance over 10 million and your income is over the thresholds that are listed on the screen, so 450,000 for a married couple, 400,000 for a single taxpayer, at that point in time, you will have to distribute 50% of the amount of your balance that's in excess of $10 million. If your balance is incredibly large and it's over 20 million, now you have to distribute 100% of your Roth accounts over that amount, and then you have to apply that 50% payout method as well. So complicated rules, again, not going to impact a lot of taxpayers. Really, I think I refer to this rule as the Peter Thiel rule. If you know who Peter is basically a founder of PayPal, and he put $2,000 of PayPal shares in his Roth IRA before it went public. And now that $2,000 is worth $5 billion. And that was released over the summer. And ever since that information was released, Congress has started to target how do we get some of these funds out of these retirement accounts. And what they're trying to do is move money from a tax-free or a tax-deferred environment into a taxable environment. So I guess I should probably back up and just give a basic overview of traditional versus Roth assets. So traditional, the assets are growing tax-deferred. No penalty until you reach age 59 and a half. No required distributions until you reach age 72. When you take distributions out, though, all of those distributions are going to be taxed as ordinary income. On the Roth side of things, when you put the money in, it's after tax, and all of the growth from that point forward is tax-free. Also, you don't have required distributions at age 72 or at any age for that matter, other than these new ones that we're talking about. So it's been very advantageous to find ways to get money into Roth accounts. And then once the Roth accounts are filled up, if you have access to them or there's ways to get money into them, then you would want to fill up your retirement accounts. And so this rule is saying, okay, these people have done a good job of saving, but now we're not able to tax any of this money quick enough. And so they're figuring out ways to get it out of the accounts and into a taxable investment account, because the assumption is that it's not going to be spent. It's going to be moving just to another investment. But then the interest, the dividends, the capital gains will all be taxed on an ongoing annual basis. So what's the planning point for this? For anyone that's over 59 and a half, you're not going to have a penalty. So knowing that this is going into effect in January of 2029, we're going to want to look for ways to accelerate some of these distributions. If we know it's coming, let's take those distributions sooner than 2029. And honestly, we even want to take them before next year, because these distributions are going to be very large and probably going to push those same taxpayers into the surcharge taxes that we talked about, the 5% and the 3%. So there's a strong incentive to look at moving that income into the 2021 tax year. Another planning point, if the beneficiary of the retirement accounts is a charity, you're going to be much better off, and the charity is going to be much better off if you take that and pass it to them immediately. So in 2021, because of the CARES Act, we're actually able to pass cash to a public charity equal to 100% of our adjusted gross income. So if someone knows that they're going to give, they have a $12 million IRA and they're going to give $2 million of that to a charity, rather than wait, they should take a $2 million distribution this year and then drive their income up by $2 million, but then in turn donate that cash directly to the charity or charities that they want to support and take the exact same deduction. It'll wash through their tax return in 2021, but in 2022, they'll be required to take a distribution and pay ordinary income tax on it without an offset. These are the retirement rule changes that I'm more worried about. We have rollovers, tax treatment for rollovers to Roth IRAs. Historically, there's been a couple of ways to fund Roth accounts. You can fund directly, but there's an income limitation on the ability to fund directly. And then you could also fund through a strategy that's been coined the backdoor Roth contribution. And the IRS has come out a long time ago and said, yeah, we know that there's this loophole and you can keep doing it until we tell you that you can't. And ultimately, this is the moment where it looks like we're no longer going to be able to do this strategy going forward. So what is it? When your income is over a certain threshold, you're not allowed to contribute directly. So you can do a two-step process where you contribute assets to a traditional IRA and not take a deduction for the amount that goes in there. And then you can convert, because there's no income limitation on conversions, so you can convert that money over to the Roth. Many advisors, many clients have been doing this for a number of years, and it's a great way to add to your Roth assets. Again, it's unfortunate, but it looks like this is probably going away in the future. There's another strategy called a mega backdoor Roth, where you do the exact same thing, but you use after-tax funds in an employer-sponsored plan, which allows you to put in potentially $30,000+ and super fund a Roth. And again, this is a strategy people have done year in and year out, but it looks like, again, this will no longer be allowed after this year. So the planning point with after-tax dollars that are held in retirement accounts is, one, if you haven't done the backdoor Roth or mega backdoor Roth strategy for the current year and you're eligible or able to do so, you want to make sure it's completed, meaning the contribution and the conversion is done prior to 12/31 of 2021. And if you have any after-tax dollars in a traditional IRA, you may want to consider doing a conversion on your traditional IRA. Now, there are some complicated rules called the pro rata rules, which I'm not going to get into because we could spend a whole seminar talking about it. But if you have after-tax dollars, it's worth looking into converting them. Just know that there might be additional tax consequences of doing so. So something we have to look at in 2021, though, because if you don't do it in 2021, you're not going to have another opportunity based on this proposal. The other item that we want to cover on this page is Roth conversions in general. So a Roth conversion is, I think of it on pre-tax dollars. So if you have a traditional IRA and you've been contributing to it over time, or maybe you had a 401k that you rolled over to an IRA, at some point you have to pay the ordinary income taxes. A Roth conversion to me is waving the white flag to the IRS and saying, you know what? I know I have to pay the taxes at some point in the future. So rather than waiting, I want to go ahead and pay it now. And what it does is it takes that balance, it moves it over to the Roth account, and you pay the taxes in the given year. But then from that point forward, the earnings on those assets will be tax-free in the Roth. Again, historically, we've had no income threshold on being able to do Roth conversions, but now, again, future dated, so in January of 2032, we will now have an income restriction on the ability to do conversions. That income restriction is $450,000 for married couples, $400,000 for single taxpayers. So many people are wondering, okay, why is 2032 the date that's chosen for the effective date? Well, the reason is because this helps them pass the budget. What they've done is they've modeled more taxpayers doing Roth conversions from now through 2031 in anticipation of this rule. So that allows them to bring in front-load tax revenue to help pay for everything that they're trying to accomplish in these bills. When it comes to planning, we need to really focus on a couple things. So one, we want to do Roth conversions periodically between now and 2032. And looking at ways to really drive that balance down if we think this rule is going to apply at that point in time. Two, once you get to 2032, you could still do Roth conversions. However, the amount that you convert is going to be included in that income figure, and you're going to have to make sure that that you stay under those relatively low thresholds. So that's a breakdown of the complicated factors that are included in the proposal. There's a lot more. There are changes to tax credits, so the child tax credit, the earned income tax credit. There's changes to corporate tax rates, a 15% minimum corporate tax rate, a 1% surtax on stock buybacks. There's international tax ramifications. There's a whole host of issues above and beyond what we've covered so far. But I think these are the most important for individual taxpayers to understand. Now, with all of that, what do we do to plan to make sure that we're doing everything we can to put ourselves in the best position going into the future? So how do we plan for the unknown at this point in time? So I think you have to take a holistic approach. You need to look at your tax return, your tax situation. You need to look at your financial plan. You need to look at your investment portfolio. And you also need to look at your estate plan. All of those items together are going to help you make the right decision, because ultimately we don't want to do something just because the taxes say so. Don't let the tax tail wag the dog, as they say. So with all of these different areas, we want to look at them and say, how do these proposed changes apply to my situation? And what can I do in anticipation? What can I do to maybe change the course of fate here? And my suggestion, again, I mentioned this before, is use professionals. There's a lot of nuance to this, as you can tell. So trying to do it yourself is probably not the best approach. Now, 2021 specific tax planning ideas. These are the 2021 or bust. If you don't do them this year, you're probably not going to be able to do them in future years. So 1, business owners or high earners, also owners of large IRAs. All of those taxpayers are going to probably want to look at accelerating income into the current tax year. Why do we want to do that? Well, we want to avoid those surtaxes. We want to avoid that 3.8% tax on business income. And we also want to avoid those new required minimum distribution rules for very large IRAs. Converting tax after-tax dollars in the current year. We've talked about this. So we want to watch out for the pro rata rule, but if we don't convert after-tax dollars today, they're probably not going to be able to be converted in future years. So what does that mean? If you have after-tax dollars in a traditional IRA, first of all, you have to track it. Form 8606 on your tax return tracks the basis in these accounts. We continue to track it every year, and as you take distributions or do Roth conversions, then that basis is taken down ratably with your balance. Again, probably more depth than we need to get into for this conversation, but just if you have after-tax contributions, consider doing a conversion or doing something about it before the end of the year. Here's one that we haven't talked about at all tonight. So deferring capital gains through an investment like an opportunity zone. So the reason that this is in the 2021 section is because by the end of this year, you have an opportunity to invest in what's called an opportunity zone. It can only be invested with capital gain dollars. So if you've realized large capital gains from your investment portfolio, from the sale of a business, from the sale of real estate, anything that's generated either a long or short-term capital gain, you would normally owe tax on that. However, with these opportunity zone investments, you can defer the gain out all the way to 2026. But the key for 2021 is investments done prior to 12/31 of this year also receive a 10% reduction in their future tax liability. After this year, you can still invest in ozone, but you cannot get that 10% reduction. And the last point for 2021 is charitable contributions. So the CARES Act afforded us some additional charity opportunity. For those that are taking the standard deduction, you could actually take $600 as an above the line deduction, or $300 for single taxpayers. Now this is cash only to public charities, but it's still a benefit that is not going to be around in 2021. For the itemized deduction, those taxpayers have the opportunity for cash contributions to public charities to do up to 100% of adjusted gross income. Usually that limitation is 60%. So that's a substantial change in the amount that you're able to do. And again, that goes away after 2021. Now let's talk about general planning. First, I'm going to talk about strategies to decrease taxable income, because that's usually more popular. And then I'm going to talk about strategies to actually increase taxable income. So if you're a W-2 employee, you want to be funding traditional employer-sponsored retirement plans. It's late in the year, so you may be already set for 2021, but you can make adjustments at any point in time, and you can defer more or less into those accounts. And then the same with IRAs. You also want to maximize other pre-tax deductions like flexible spending accounts, health savings accounts. You may want to look at, if you're over 70 and a half, executing what's called a qualified charitable distribution. This satisfies a required minimum distribution from your IRA, and it does not hit your adjusted gross income. So it's almost like that income never happened. So it's a really powerful strategy for those that are charitable, over age 70 and a half, and have large IRAs. Consider utilizing like-kind exchanges when selling real estate. So it's a 1031 exchange. It's a way to, again, defer gain from the current year into future years, or potentially defer until death and then never pay the taxes, get a step up in cost basis. Harvest capital losses to offset gains. So gain loss harvesting at year end is popular. You can completely offset long and short-term capital gains with long or short-term capital losses, but you can also offset up to $3,000 of ordinary income. Here's one of the most important ones: accelerate the state and local tax payments. So if you know you're going to owe on your state tax returns in 2021, make those payments before the end of the year rather than waiting till either January 15th when the fourth quarter estimates due, or April 15th when your balance is going to be due. And lastly, consider advanced charitable giving strategies. So in addition to the QCD, qualified charitable distribution, that I talked about before, there's things like donor advised funds, there's donating appreciated stock to charity, there's charitable trusts like charitable remainder or charitable lead trusts. There's plenty of opportunities out there to do advanced giving. Ultimately, if you're charitable, they're going to make sense. If you're not charitable, it's not like you're not going to receive a tax benefit to make you charitable if you're not already doing so. So this is for someone that's charitable and maybe needs the tax deduction in the current year as opposed to in future years. So really it's a timing mechanism. All of these things are timing mechanisms. We want the deduction now, but we want the assets to go to charity either over time or at a future point in time. Lots of ways to get that done. What about strategies for actually increasing taxable income? You can fund Roth accounts through your employer rather than funding traditional accounts. You can accelerate business income. So if there's any way to push business income into the current year, you want to do that. You want to defer business expenses. So if you can forego an expense till 2022, do so. Potentially opt out of accelerated depreciation. So depreciation right now, there's ways to expense things in the first year. You can take 100% of equipment or other items that you put into place during the year. Many times that makes sense, but in certain circumstances, you might want to spread it out over time. And then go ahead and realize capital gains. Just because you like a stock position or your advisor likes a stock position doesn't mean we can't lock in gains, because you can lock in that gain and then turn around and reinvest at a now refreshed or updated cost basis. And there's no wash sale rules when it comes to realization of capital gains. So you can do that and then turn around and reinvest right back in the same position, just with that higher cost basis. Potentially defer those state and local tax payments. So the state tax payments are easy, the state income tax payments. Some, depending on your jurisdiction, you might be able to defer your real estate, your personal property tax. Those items you might be able to push into 2022 if it makes sense based on your overall situation. And then lastly, deferring charitable gifts. So we talked about the strategies available to make those gifts happen up front. Instead of doing it at the end of this year, push it to January of next year. Plenty of ways to, again, look at just passing those or pushing those off. So what are the next steps? What do we do at this point? Ultimately, like I said at the beginning of this presentation, this is very specific to your situation. So if you want assistance, if you want to talk with Larson Tax Partners about your specific situation, we're happy to talk to you. Reach out to your advisor if you have a LFG advisor. If you don't have an advisor, I've got my contact information on the last slide. You can reach out to us directly. We are very much focused on being tax planners and not being tax preparers. We're trying to strategize for our clients over a long period of time. How do we make sure that we're reducing the tax bill over years? And we're not just filling out the forms. So we have a flat fee service where we include planning. and we have different levels. So depending on what you're looking for, we have silver, gold, or platinum levels. You choose what you think is right. You always have the opportunity to either upgrade or downgrade throughout the year if you don't think that you're in the right plan. So definitely interested in talking to you and would love to help do some of this planning as well. So with that, I'm going to turn off my camera and I'm going to look and see if there's any questions that we want to look at this point in time. All right, so we have a couple questions coming in here that I'm going to answer. First question is in regards to natural gas or oil and gas investments as a way to offset income. That is absolutely an option. With these types of investments, what you're able to do is take an expense or deduction in the first year for intangible drilling costs. And those intangible drilling costs, depending on the structure of the investment, can offset not only passive income, but wages, capital gains and loss, or capital gains, other ordinary income items. So it's a way to drive down your adjusted gross income, and there's not a lot of ways to do that. So that's a good question and a good point. So here's a question on after-tax contributions in 401ks. So the question is, are there changes? And ultimately, the answer is no. You're still going to be able to do after-tax contributions within your employer-sponsored plans, 401k, 403b, assuming that they allow you to do so. However, you're no longer going to be able to convert those dollars. They're going to be really stuck in that after-tax bucket. So what that means is you're going to have basis in a traditional retirement asset. So it's going to continue to, the growth will be taxed as ordinary income in the future, but the basis will be tax-free. Another question on the intangible drilling costs. So the costs are the direct and indirect costs associated with drilling wells, et cetera. So it's really just a clarification from the same person who asked the question. So yeah, the way it works is the partnership or the investment, they report out what those intangible drilling costs are. And then as a share, or as an owner, you get to claim your portion of those dollars. So I've got an interesting question on hobbies, in particular hobbies with car collection in this case, but any strategies utilizing a hobby that allow us to drive down tax liability. Ultimately, in order to take any deductions for something like maybe a car collection, you would have to try to make a profit. You know, to have a business, to have a Schedule C, which is ultimately where you would probably have maybe a car collection. You have to prove that you're trying to turn a profit off of that investment or off of that business. So I don't know how you would do that if you were, you know, posting. You had a website and you were letting people come look at your cars and you charged a fee for them to come in, then, you know, maybe you could make a case for it. I can't imagine though that you would really want to subject your cars to that. And then also, if you don't show profitability in really a 3-year window, then the IRS is going to come in and they're going to audit you for hobby loss rules. So probably not is the ultimate answer there. Here's a question on the loans from the stimulus package and how they impact small business taxes. Yes, I mean, there's going to be impact. There's actually some changes. The infrastructure bill that passed last Friday, that infrastructure bill actually ended some credits for 2021 as well, ended them early. So the answer is yes, it's going to impact how it's going to impact things. Ultimately, I think it's going to be on a case-by-case basis, and it's going to be something that we would have to look at your specific situation to discuss further. And again, we've cleared out. It's 7 o'clock, so at this point, I think I'm going to go ahead and shut down the webinar. Again, I appreciate everyone for joining. If you have any questions, if you'd like to discuss further, by all means, please feel free to reach out to us one way or another. Thanks and have a good night.